In this session, I would like to look at the basic principles of accounting which drive the preparation of financial statements. And as we all understand, the financial statements that are prepared and published by the various companies help the financial analysts to evaluate the performance of the firm, and based on that provide some kind of recommendations with respect to the investment in that particular firm, or help towards the lending decisions for that particular firm, or help in mergers and acquisitions deals with respect to that particular firm. So, for taking various decisions relating to investments and lending specific to that particular firm, one of the most important tool is the financial statement of that particular firm. And what we see is those financial statements are typically prepared under the various basic principles of accounting. So what these basic principles talk of is what financial items, what financial transactions that happen with respect to the firm, what financial items to measure and how to measure them, when to measure them, how are they represented in the financial statements, what kind of values are leading into the financial statements. All that is being driven through this 12 major basic principles of accounting. So an understanding of these 12 principles will actually make us understand in what mechanism the financial statements are actually prepared in the real world. So let's get into them. So a couple of them to start with. First, understand what is an accounting entity. That's the first principle. Entity. So here an entity is someone who is separated from the owner. It's a virtual kind of an entity for which the financial statements are prepared. The financial statements are actually not prepared for an individual. Financial statements are prepared for a virtual entity, which is like a corporation, or even if it is a proprietorship, it is treated as a business unit or a business entity for which the financial statements are prepared. So always remember, whenever the financial statement is prepared, there is a mention of an entity for which that statement is prepared, and that is what we call as an accounting entity. The next principle that governs the preparation of the financial statements is a going concern, where the assumption is the firm or the entity, whatever we are referring to, it exists for indefinitely a longer period. If it is a human being, obviously there is a death associated with that person and there is an end to that particular person. But when we are defining it something as an entity, which where another assumption is this entity is going to exist for infinitely longer period, though in reality that need not be true and it cannot be verified as well. But what we see is that is one of the most important assumptions that goes in while preparing any financial statement. So which means even though the financial statement has been prepared for this particular year, it assumes that whatever the company is left with at the end of the year, it is going to use them in the next year. Let's say it has purchased a building this year. Right at the end of the year, it makes an assumption that the building will be used for the business for the next year also, which means it is making an assumption that the business is going to continue even in the next year and the years in the future as well. That is what is being driven by this concept of a going concern. The life of the business entity is assumed to be infinitely long, though in reality it need not be the case or it cannot be verified. But from an audit perspective, what we can very well look at is, in case an auditor really feels that this particular business cannot continue, or he is sensing that there is some kind of a problem that is associated with this particular business and it cannot continue, he can issue what is called as a qualified opinion about that company, wherein he clearly can state that there is some doubt with respect to the potential continuance of the company. So the auditor is expecting or is sensing some kind of possible future demise of the company. That can be mentioned as a part of the audit report. But as long as far as the financial statements are concerned, they are prepared in accordance with the going concern mechanism itself. Then, the financial statements very strictly follow this concept of measurement. Only those particular items which can be very much reasonably measured, quantified, only those things can go as a part of the financial statement. Probably loyalty of consumers or intellectual capital, which cannot be measured or which are not coming as a part of the agreement, we cannot represent them in the financial statements. Only those kind of items that can be measured clearly, or there is some kind of an agreed upon value, only those things get into the financial statement. Though loyalty of the consumers or intellectual capital of the resources, they play an important role in the success of the business, they do not make their entry into the preparation of the financial statement, which means the company ends up ignoring many valuable assets which definitely contribute to the success of the business. That's one more thing that we need to be understanding as far as the financial statements or accounting principles are concerned. Then we are looking at another principle which we call it as unit of measure. There should be a clear-cut presentation currency. In which particular currency are we presenting the financial statement? So if, let's say, the domestic currency itself is the presentation currency, then any other foreign subsidiaries that are there, any other foreign transactions that have happened, all those things need to be converted into this single presentation currency, and based on the exchange rates at various points in time. So some kind of rules are very clearly associated in terms of what exchange rate needs to be taken for what kind of conversion. So the various transactions and purchases or various activities of the foreign subsidiaries, they need to be converted into this single presentation currency and consolidated for the presentation of the various financial statements. So the unit of measure, the currency in which the financial statements are presented, they need to be very clearly understood, and a company can present the financial statement only in one single currency. All the other transactions need to be converted into that particular currency only. Then we talk about a mechanism of historical cost, which means some of the items are represented in the financial statement at their original cost itself, the cost at the time of the purchase. though in the current times the value would have either gone up or gone down, there is no revaluation that happens. That was the original accounting principle that started off with, wherein we talk about the various elements of the financial statements are measured at the original cost itself. There is no adjustment for inflation. And because of that, some of the assets that might have got purchased long time back and they are not revalued at all, we see that their value is very greatly understated, and that is where today this particular assumption got challenged, this particular principle got challenged when we see international financial reporting standards where the historical cost is slowly giving its way towards the concept of fair value. So we'll discuss about these things slightly later in the coming session. But the core accounting principle under which the financial statements got prepared was the mechanism of historical cost only. Then we are talking about another principle, which is the materiality principle, wherein we are more looking at the relative importance that needs to be given for the different financial information, especially when there is a kind of a necessity or when there is a possibility that a particular information will definitely affect the financial condition of the company. It needs to be definitely reported. Some small minor issues can very well be ignored, but if some kind of a financial information is expected to have some kind of impact on the financial performance of the company, that particular information needs to be definitely reported onto the financial statements without any hesitation. But anything that is minor and maybe only for a record purpose, then even if it is not highlighted as a part of the financial statement, that's not a big deal. Then the other principle that is very much essential for us to understand is the estimates and judgment. What we see in the preparation of the financial statements is different estimates and judgments are made at different points in time. Probably when you are selling something, when you have sold a particular good, or when you have sold 100 items, and you are expecting in general out of every 100 items that you have sold, let's say 1% of them come back because of defect, and they are replaced during the using the warranty mechanism. Then it means that probably the revenues whatever you are getting are only for the 99% of the items and not for 100. So now what the accounting principle says is, now when you have sold 100 new items and you reasonably expect that 1% of them come back because your historical experience is saying, you can very well recognize the revenues and the profits only for 99 goods that you have sold instead of 100, because the assumption and estimate and whatever you are making is more and more reasonable. So what the accounting principles say is, whatever the estimates you are making, whatever the assumptions you are making, you can go ahead with the guesswork if that is the best whatever we can do, and you are expecting that the error would not be that drastically higher. So as long as we expect that the changes will not be that the error will not be very heavy, we can go ahead with the usage of the estimates and judgment. But what is being mentioned by the accounting principle is, go ahead with consistency in the guessing method. So let's say if I have used some based on the historical number, I have used 1% as the number of defects that can come back. But next year I have changed it to the percentage of the defects of my competitor rather than my own defects. So the estimation mechanism is changing. So what the accounting principles talk of is the estimation mechanism cannot differ. It has to be consistent across the different financial years. Then there is another principle that is driving the financial statement, the consistency. Whatever is the method of reporting that we are using, choose a single method and use it consistently. For example, for valuing, let's say the inventory, there are various valuation mechanisms. There is a LIFO mechanism, there is a FIFO, first in, first out. There is an average cost mechanism. There are different kinds of mechanisms that are there to value the inventory. Now, what the accounting mechanisms simply say is, if the firm has chosen, let's say, FIFO at this particular moment to value its inventory, let that method be consistent across the various reporting years. So they should not change from year to year just to take an advantage of the weakness of the differences that are there in two different models and try to use it to the advantage of the firm. So there should be a single consistent method in terms of reporting over the various financial years. Then we are talking about a principle called conservatism, which generally exists with various financial transactions that get disclosed onto the financial statements. Anywhere the measurement bias is always on the downward side, which means there is a possibility of an understatement in majority of the financial statements compared to the overvaluation. For example, the financial statements generally talk about, if at all the loss is expected to occur, they talk about recognizing that loss immediately in the income statement, booking a loss immediately in the income statement, even though the loss that is going to occur in future. Whereas when it comes to the gain, until it is realized, it is not being treated as a gain in the financial statement, which means it's a conservatism approach. Any loss that is sensed to occur will make an entry into the financial statements immediately, but any gain that is sensed to occur will make into the financial statements only when it is realized in reality. That is another important principle that drives the financial statement. Then periodicity is the next important principle, wherein it is assumed that the entire company's lifetime can be divided into more and more reasonable and logical time periods, and for each of those time periods the profits, the losses, the assets and the liabilities of the company are collated and reported. So the financial statements are prepared for a specific period of time. Sometimes it could be monthly, sometimes it could be quarterly, sometimes it could be annual. But there is a kind of a time period that is specifically chosen, and the financial statements are prepared for that period. Means whatever the transactions that have occurred during the period, whatever the profits or losses that have come up during that particular period, they are all collated and represented. So financial statements generally are associated with a particular period only. Then we talk about another important rule where the substance is preferred over the form of presentation. It's an economic substance. For example, we talk about a company X taking an equipment on a lease basis from Y. So here, if at all it is censored that X has been taken from Y on a lease basis, but if it is really censored that it is as good as a purchase, and there is not much of a difference here between purchasing that equipment versus leasing the equipment, then the accounting rules talk about it's better to represent it as a purchase itself, though the terminology is different, that it is a lease, not a purchase. But if the characteristics of the lease look more or less similar to that of a purchase, then it should be better represented as if it is purchased rather than it is leased. So that is where we talk about the financial statement should reflect the real economic substance rather than just the form of operation. So that is one another important principle driving the financial statement. And finally, the most important of the principles that is driving the financial statement is the accrual basis of presentation. So what it simply talks of is the three major dimensions come into it. How do I really recognize the revenue in the financial statements? And how do I look at the expenses, which are direct expenses, the expenses which are directly related to the generation of the revenues, and how the allocation of the various other costs is done. Basically, when we are talking about the accrual basis, the major major driver that comes up is if any business action, selling or purchase or whatever, if any business action in a period is making money, then all the costs and business expenses associated with that particular business action needs to be reported in that particular period only. That is the major principle driving the accrual basis. So looking at it in detail, probably there are three components in it. One, the revenue recognition part. Two, the matching principle, where we match the direct expenses with that of the revenues. And finally, we look at the allocation of the other costs. So on a broader note, when I look at the revenue recognition principle, it simply says whenever an item is being sold and shipped, whenever a product is being sold and shipped, that is when the revenue gets recognized into the financial statement, not when the cash is actually received, or not when the cash is actually received in advance or in arrears. So what is it is simply saying is whenever all the necessary activities to provide that good or service have been completed, only then the sale is getting recorded in the financial statement, not when there is an exchange of cash. So the payment of cash or the receipt of cash has nothing to do with the revenue recognition in the financial statement. Only when a product is actually shipped, it gets into the financial statement. It gets into the financial statement as a revenue, but until that time, it does not get recognized as a revenue. That's one important point that we need to look at. And as far as the expenses to produce that particular product are concerned, for example, when I am looking at a car has been sold, means all the activities to ship that car to the necessary party, the ownership transfer of that car to the necessary party has happened. That is the period in which the revenue for the car is booked. Now, whatever is the cost that is involved in terms of producing that car, it could be the materials cost, it could be the labor cost, which are directly associated to the production of that particular car. So all those expenses are also recorded at the same time of matching of the revenues itself. So in whatever the period in which the revenues are recorded for them, It's the same period where the expenses are also recorded for them. The direct expenses also are recorded for them. That is what we call as the matching principle. And any other costs, there could be lots and lots of indirect costs that are allocated. The selling, the administration costs, various other costs that may not be directly linked with the production of the car, they are allocated to the different periods using some form of a logic or the other. They could be equally distributed across the 12 months, or they could be recognized or recorded whenever they arise. Or there should be a different rule in terms of allocating the cost for each of those items, and based on them their entry into the financial statements typically happen. And one single important point that we should not forget is all the businesses which have inventory with them, they should definitely use an accrual basis of accounting itself. Only those kind of firms probably which do not operate any kind of an inventory, they can think of using cash basis of accounting, but any firm that goes with an inventory should definitely go with an accrual basis of accounting itself. And typically if we try to understand who is preparing all these accounting principles, so there is a board which sets in different countries, each country will have its own board which sets up the various accounting principles, and the different companies in that operating within that particular country, they have to abide by these accounting principles definitely. So generally they are looked at, any accounting principles are typically looked at as set of conventions, rules, procedures. So a lot of detail is offered on each of these counts for preparing and reporting these various financial statements. The major intention is provide more and more consistency, improve the standard in terms of financial reporting, and the more and more consistently they are prepared, the more it is easier for individuals or general public to compare their financial statement, get educated on the way the companies are performing. It brings a lot of consistency in terms of how these financial statements can be used for various investment and lending decisions purposes. So what we typically observe is this financial statements, whatever are prepared, they have to abide by these various accounting principles, and knowing these accounting principles makes someone very easy to understand the logics that have gone behind the preparation of the financial statement. This is the base in terms of preparation of the financial statements. Alright. In case you have any further queries or questions regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.